Today, we have a CPA turned wealth strategist with us, and I am super excited to have Keith with us because he is one of the smartest guys I know. He has helped hundreds of high net worth investors and high income earners significantly optimize their portfolios to help them grow their wealth faster. So, one of Keith's true strengths is helping people reduce their tax liability, and it is not uncommon for him to help people save tens of thousands of dollars when they work with him. So if you're a high income earner, you're a doctor, you're an attorney, especially you business owners, and you are here today, I'm excited, and this is going to be a great episode for you. So if you're looking for ways to invest smarter and safer, this one is for you. And if this is the type of content you are looking for, make sure you hit that subscribe button wherever you listen so you don't miss future episodes. And let's jump into it.
All right, Keith, thank you for being here today. Glad to have you on.
Thank you for having me.
Okay, so I want to give a brief little intro for Keith. I actually met Keith a number of years ago at kind of an after hours, like business meeting with people. And Keith was this guest speaker who I didn't know. And everyone had sat down, everyone took their seats, and they were ready to hear this guy who was here to talk about something important. And Keith began his little pitch with, "Hello, everyone. I'm here to talk about Amway." And then he paused, and everyone freaked out for about half a second, and then they chuckled because it was a joke, and he went into what he does. And really, that's kind of why I wanted Keith to be here. Is he
to
runs
talk about Amway?
Yes, exactly. To talk about Amway. So, but really, Keith runs a group called Financial Journey, and we'll get more into that in a little bit. But Keith's been in the investment world for many years. His background is a CPA, which I do want to touch on. His background in alternative investments, and that's really what I want Keith here for. Just his wide breadth of knowledge and expertise working with really passive investors, and his understanding of like general partners and the people who put deals together. So Keith, thanks for being here.
Thank you so much for having me. It's a pleasure.
Yep. Well, hey, I want to just get straight into the meat of it. We're in a not awesome market right now. We are in an odd investment environment. For those who have been paying attention the last couple of years, haven't been super fun. So what are you seeing right now in the market? Not necessarily for just alternative investments or people who are already passively investing, but what do you see are the pain points for people who are maybe high income earners, small business owners, and maybe they've always kind of followed the traditional route?
I think the main thing that's plaguing the market is uncertainty. People don't truly know where to put their money. There's been the real estate market. If you've been invested in apartments the last 18 months, there's been a lot of capital calls in that industry. It's been a struggle. S&P 500 is hitting all-time highs, and then we've got tariffs, and then it goes back up. Part of what it is, in the past, a lot of folks, including the Fed, are still really focused on the market economic fundamentals. And there's really been a shift that a lot of people have missed, at least for the foreseeable future. The market's going to be more driven by political factors than the economic fundamentals. So the president imposing tariffs, pulling them back, putting them back on. We've got border, ICE, kind of a changing world order. I've had several people ask me, like, how do we invest? Like, what is your prediction for the future? I wish I had a crystal ball. I pay attention to a lot of really smart people in this industry, and a lot of them disagree with where we're going right now. Some are saying we're going to go into recession. It's going to be terrible. Others saying we're going to work our way out of it. And there's so many different factors and indicators that are going different directions, that with Trump, especially his first 100 days in office, pulling almost all the levers at once, nobody really knows what the result is. If we're pulling a handful, we can kind of figure it out, but there's so many things that have changed so fast. It is tough to invest thinking the market's going to go a certain way, which is why I don't want people to invest in that way. I really want people to find something that they know and understand and invest in one of those ways. And there's a handful of ways I'd really like to get across to your audience.
Okay. Yeah, and that's this is kind of just a timely thing. But when you talk about like the markets, I was actually talking with a buddy from church, and I kind of he's just a kind of a traditional financial. I think he's a CFP, certified financial planner. Operates for a big brokerage, kind of does the traditional thing. And I asked him about what was going on, and actually this guy worked for J.P. Morgan. I won't give any names, but I was like, "Well, how's it doing?" And he's like, "Man, it's been a ride this year." And I commented on something I learned from your last event that I went to, and it was comparing the typically recommended portfolio split, which I think I'd love for you to talk on the kind of your recommendation, but like the 60-40 stocks and bonds versus if you just always had your money. You'll probably correct me because I'll probably be wrong. But was it just the S&P 500 or was it just like the standard market index? Or I think it might have been Cody talked about this historical comparison. So if you go back 10 years, how they do against each other. If you go back 20 years, how they do against each other. And basically, no matter how far back you go, I'm thinking it was the S&P 500, outperformed the traditionally recommended 60-40, portfolio split. Does that sound right?
Yeah. So typically people look at stocks and bonds and think that's diversification. And in many ways, it's diversification until you need it. So 95% of the time, the correlation, it's properly diversified. But the moment we need to be diversified, like there's a big market drop, both stocks and bonds are going down at the same time.
Mm-hmm.
And that's why the S&P 500 has outperformed the last 15 years. The other point that was really made in that presentation is if you're able to invest just like the politicians, it's amazing how some of these guys are getting to 200 to 300% returns.
It's amazing.
Pretty amazing.
Yeah.
Almost like there's some insider stuff going on.
Yeah. Yeah. Well, and so in that conversation, I brought that up with my buddy and I asked where the market was this year. And so he said this year, year to date, the market was up a half point. And he might have been talking about the S&P 500 specifically, but about a 25% drop in April. And I don't follow the stock market super close myself, but a big drop and a climb, and it's been tumultuous and all that heartache for half a point.
Correct. And the S&P really has served a lot of investors well over the last 15 years. I think there's going to be a shift, though, with us reaching consistently higher PE earnings, price to earnings ratios, that the way things are really shifting is stock picking, like good quality stocks, the Warren Buffett method of finding things at a discount, good companies you think are going to do well, and investing in those. And a lot of the things in the United States are great options. We've also been looking at some fantastic options abroad and really doing that deep due diligence around the world.
Okay, cool. So we don't want to beat up on the typical anything too much, right? But I do want to talk about when you might have just hinted on it, but where do you see some of the opportunities being for investors in today's market?
So instead of focusing on where the economy is going as a whole and all that uncertainty, I want you to use three things to guide your investing. So for me, I'm personally a value investor. I like to buy at a discount. When I buy when things are down, my risk goes dramatically down, and my chance of a high reward, high upside is significantly better. I'm not personally a momentum trader, but if you did want to start maybe a Twitter fund and follow along with what Trump's doing, I know some people that have actually done really well with that. And if politics is driving that could be a strategy for somebody who really wants to be on top of it. But my real suggestion is pay attention to a handful of stocks in an industry and buy when there's a drop, or find something that is going to do well regardless. The other thing is have more liquidity. A lot of people in our network have been in these long-term private equity investments, like apartments, where they were supposed to get their money back after 3 to 5 years, but we're going on 5 to 7 years, and sometimes cases there's been bankruptcies. And so really there is a time and a place for that, but having the liquidity, where some people were asset rich and cash flow poor, has really hurt them.
Yeah. Okay. So, you're a value investor. You mentioned specifically the Warren Buffett method, but just from my knowledge of you, right? And our listeners don't know this yet, so I want you to kind of talk about it. You're not just talking about stocks that you're a value investor. So what other alternative investments have you been in, or what's your personal experience?
So I've personally syndicated commercial real estate deals and invested in a lot of things over more than a decade at this point. And
All right, so before we jump too far into it, syndications. If we have a newer listener, someone who isn't real into the alternative world yet, what's a syndication?
It's where somebody raises money from a private group of typically accredited investors, meaning people who either have $1 million net worth excluding their primary residence, or are making $300,000 a year if they're married, $200,000 a year if single. That qualifies them from an SEC perspective. Then go into a lot of these private equity deals or private real estate deals. In the last 10 years, I've invested in startups, oil and gas, all sorts of commercial real estate, stocks. To an extent, I'm industry agnostic, and I've had some bruises along the way. The way I get comfortable about things are finding people I can trust in an industry and going deep with them. For example, in our community, our doctors and lawyers in the group know nothing about vetting oil and gas deals, but we've got a private, a community due diligence council, and we've got the chief drill officer of a publicly traded company in that group, that a company that many of your listeners would probably recognize, and he'll go 3 layers deep on that investment, and we'll eliminate 80% of the oil and gas deals we find as either feeling a little too scammy or never truly going to make money. They're only a tax deduction, and it's an
expensive tax deduction.
It's an expensive tax deduction, but anytime somebody's marketing just for a tax deduction, that's a red flag. So all that to say is, so he might vet our oil and gas deals. Our doctors in the group help vet a medical practice buying fund a while back. Our real estate guys, we've got guys that own a whole bunch of self-storage units. They'll help vet a self-storage fund. And so it's really that community approach where you've got other people who aren't making money. They're off of how you invest. And it's a way for you to truly get comfortable around some of these through that deep due diligence, just like family offices at the billionaire level.
Yeah. Yeah, that's been, and just for like full transparency's sakes, I've been a member of Keith's group for going on 4 years now, Keith, something like that.
Yeah.
And so it's been a big benefit to me personally. And I'm not any of those experts. I'm the guy who's dabbled in a little bit of this. I'm, invested in a couple of different startups or companies, a couple of apartment syndications. I think I'll have taken my first big bruise on a pickleball club investment that does not look like it's turning out well. I think they're currently liquidating their assets, so it's definitely not turning out well. But yeah, this has just been a neat thing for me to get to continue to learn and grow and get exposed to more people who have a lot more knowledge than me. But okay, so you've syndicated some of your own deals. What were a couple of the deals that you actually syndicated?
Yeah. One was a hotel in the Dallas-Fort Worth area. We returned a 54% return in just 2.5 years, which worked out well. And then shortly thereafter, COVID hit. So I'd like to think we did that well.
So when did you exit that?
Oh, it was actually more like 2017. So,
okay, you exited a couple years before COVID.
Yeah, we did. There was some new development coming in. It was in Allen, Texas, for those that know the area.
Okay, cool. So a hotel. And did you run that as a hotel, or the new thing that's going on right now is hotel to apartment conversions? It wasn't that, right?
Correct. So we've got a background doing active and passive investments in hotels and apartments. My wife, as we were first learning the industry, got in, ran it, acted as a general manager, did that for 3 months. And then we brought in an independent, another general manager after we felt like we learned the business. And so if you ever want to get into any asset, I feel like hire a coach who knows that industry and get around a community. That combination is the best way to get ahead and figure anything out.
Yeah. And now just to be clear, this isn't, this show, this podcast, these interviews are not geared to teach anyone to be a general partner or to go syndicate their own deals.
No.
And what Keith said is accurate. You want to find a coach, you want to find a program. And if I'm not mistaken, you kind of went through one of the big programs in the Dallas area, right?
On hotels?
Oh, I guess, yeah. I don't know anybody.
No. So to be clear, we actually hired a hotel management company. So if somebody's going to charge you $50,000 to go into their coaching program, usually at that price point, you can hire the management company to do it at a similar price point. You've just got to learn a little. We had already had some previous experience with commercial real estate, which helped us. But just if you can find a buddy, a friend, somebody that knows that's willing to walk alongside of them, possibly give them 10 or 20% of the equity and just have them walk you through the deal. That's almost more practical than paying the big coach, although there are lots of people willing to take your money.
So is the hotel deal the first deal you did? Is there a syndication? Or had you
no,
done some
we did it. We
apartments?
did another one passively. Oh, this is a good one. I don't look good from this, and that's fine. I want to be raw. So our first deal, we were passive, learning from somebody else, and this all sort of happened a little after we got our deal under contract. We bought into a hotel project in Lafayette, Louisiana, and I never really wanted to go back to Louisiana since. In short, we had another couple who was not experienced, and we hired a general manager who ended up looking at everything they could do fraud-wise and said, we're going to do all of it. So ended up like taking over the hotel every morning, took out whatever cash was in the drawer, ran off, flew in an $8 an hour housekeeper while he was out in Atlantic City gambling. He had taken the hotel shuttle halfway across the country to go gambling and flew in housekeepers, took over all the liquor that was in the restaurant. He had a good 3-week run, and then the first month of bank reconciliations and stuff came up, and I was the accountant on it, also a passive investor, and I quickly noticed that there were some issues.
There were some issues.
So I helped put him in jail for, I don't know, it was 5-7 years. And then our maintenance man was found with cocaine and hookers in there. There was just, I could go on. It was one thing after another. And so that's the kind of deal where you learn everything that could go wrong. Yeah. And there were a lot of lessons.
That was your schooling you paid for, right?
Yes, it was. It was an expensive, well, it was $50,000.
Well, you know, it's as terrible as that story is, it is nice to see that somebody for once went to jail for fraud, which I feel like, and this is something that I'd also want to talk about, maybe just to touch on, is how wary limited partners or passive investors should be, and kind of the kind of due diligence they need to do when choosing to invest in someone. And you talked about finding someone you trust, but how do you ferret out that kind of stuff when it's someone you don't know, right? Because there's lots of people who are not great people in an industry where they're working with other people's money, unfortunately.
So you got to start, I would say, back up with a mindset shift. What makes an entrepreneur successful is your endless hope and optimism that this is going to work out, that you're just going to keep plugging away. And often you do eventually work out. Mm-hmm. As an investor, though, you got to take the opposite approach and almost be a little cynical. And so often when we're working with folks, we will find business owners that have just had a big 7, 8, 9-figure exit. They've got all this money. They feel successful. They just sold the business. And then they have to go give it to somebody else, and they trust blindly, or they feel like they just had a big moment of success. They have their big winning the lottery moment. The biggest way to know who's going to declare bankruptcy, or the biggest indicator of bankruptcy, is winning the lottery. And so a lot of people have their own lottery moment, and then they go invest with all these people, and it doesn't go well for them. And so there's got to be a switch to, how do I do due diligence on this, and getting around a healthy group of skepticism. There's all sorts of people that are going to market to you. That's why we built a community. And I've ultimately taken myself out of the due diligence process. When you've got 7 people that are skeptical in a healthy way, we invite our other members to be part of that process so you can learn. That helps eliminate so many deals and risk factors, because we've got a thorough due diligence process, which we've been told is more thorough than many family offices.
Okay, that's good to know, especially because I'm in that group and I get those recommendations. So tell me, you mentioned with the accounting background, I mentioned that you're a CPA. Give us like the brief backstory of how you got into kind of the syndication world from being a CPA.
Yeah. So started my career at Deloitte in San Francisco, originally as an auditor, went to work for some former Deloitte partners on the tax side in Dallas, where my wife grew up. And then from there, started my own CPA firm focused on high net worth real estate investors. So a lot of apartment syndicators. So I was lucky enough to know who a lot of the best performers were, and I placed money with them, and that helped. Fast forward, um, while we were doing that, my wife actually worked at a local group called Lifestyles Unlimited, helped manage their program. And so we got into rentals in
Hmm.
2010. I thought I'd like to think I was a genius, but it was also a mixture of luck of just timing it right. And so
Yeah.
initially we bought rentals, flips, wholesaling, and then graduated to apartments and hotels, which really made a difference for us.
Yeah.
2016, 2017, thought the market was going to crash. Hillary Clinton was going to get elected. I was wrong, but we had a big exit through all that. And so syndication was the natural flow of how you got into commercial real estate as part of that. And that was something we felt comfortable stepping into, partly because we had a whole community of people. A lot of my Jessica was in that world,
Hmm.
and I was in that world with a lot of my clients. And so I knew one skill that really helped me step in to that world as an accountant.
Yeah, that's great. I actually got my personal investing start at Lifestyles as well. And so I was young. I was like 22 or 23, recently married. My dad paid for me and my wife to go to the seminar with he and my mom. And that's where we were exposed to kind of that buy, flip, refinance method. Didn't get to do too much with that initially, but I transitioned into real estate. I've been a real estate broker for 8 years. And so I was doing flips for a while. Again, rentals, I still have some rentals. I was doing flips, some wholetailing. And my first big loss for myself was when I decided to, rather than just do the really good deals that fell into my lap from my normal real estate business, I decided I was going to start paying for like Google pay-per-click and do the, hey, I'll buy your house cash advertising. And I hired a firm, and, it's fairly expensive to work with them, and then a lot of money on advertising. And I started that in early 22 or late 21, maybe. I bought my first house in April of 22 off that advertising. Only bought one house off about $50,000 to $60,000 in advertising. And then I had to stop because the market was just getting real bad. And then I lost $20,000 on that house. uh, that,
That's rough. That's real
yes,
education, though.
it was real education. That's actually, I think, maybe the first year or year and a half I was in your group. And in my head, I was like, hey, I am going to manage all my own money actively. I'm not going to put any money into retirement accounts because I can't use it on my own deals, which I will talk about in a second. So I won't put any money in retirement accounts. I'm self-employed, and I'm just going to manage everything myself. And that was basically my intro to trying to manage it all myself, was about a $70,000 lesson over the course of 8 to 10 months. And coming out of that, I've gotten to and we've had conversations about this, is like, I really should probably focus on my core business, what I'm really good at, making money the way that I'm wired to make money, and then use that excess cash to invest. And so really a kind of a personal thing for me, but I think it'd be great for people who might be newer to this whole world. What are the options you have when you have a retirement account? Is it just the stock market?
Yeah, that's a great intro to understanding that you can self-direct your retirement
Mhm.
funds, and you can go into just about anything, whether you have an IRA or 401k, and that's part of what one of the strategies our community will utilize, or even how to move it from a traditional to Roth account at a 30 to 70% discount. There are ways to really marry the investment strategy with the
Mhm.
tax strategy and get further faster.
Okay. Yeah, and I don't want this to turn into a talk about retirement accounts. But there's a lot of people, or like the intricacies of it, right? But there's a lot of people who they have leftover 401ks from an old employer. Maybe they are self-employed, but they set up some retirement accounts and they've been feeding those. They might be 10, 20 years into feeding a retirement account, and they basically have everything in the stock market or an index fund. And they're not terribly pleased with the emotional turmoil that is being caused right now. So what kind of things in general could they choose to self-direct into?
There's a few great options. So one, if you just want consistent, reliable returns, maybe some sort of debt fund, especially in this market, earning 10 to 12% is a great way to just recognize interest income. You can get into real estate projects. You can get into certain private equity projects. I would only go into a private deal if you have a high conviction rate and you feel really good about it.
Yeah.
And I would also limit what you do. There's certain things that we do, certain portfolio guidelines that we use to help guide our community, so you're never at risk of really losing it all, having your cash flow. Like there's multiple elements out there. And don't start big, like transition over time, see results. After you get results, then do more.
Okay. So we talked about kind of that traditional portfolio, the 60/40. I mentioned earlier that there might be kind of a recommended portfolio that you have for your clients, right? This might not be for everybody exactly, but tell me a little bit about what some of your general recommendations are when it comes to how you might choose to break down your portfolio.
So we look to how are family offices managing their money. So if there's a bunch of people that put out reports. UBS does a global, worldwide reporting of what their family offices are in. And right now, they're about 55% alts in the United States, about 45% traditional. That's actually up 5%, a movement towards more traditional publicly traded assets from 2024, meaning that the family offices will make their big play. So they're going to earn the majority of their money in alts, which can be real estate, private equity, non-publicly traded assets in Texas. There's a handful of really good oil and gas operators. You got to dig, but they can provide phenomenal returns if you know where to invest. And that's part of what we try to share with our community after our vetting process. And then beyond that, it's having a good way to trade. And a lot of people get overwhelmed. It's almost impossible for any single person to be good at every area. You've really got to find either different experts or people that can do that, because you can't have 3 decades in an oil and gas career, 3 decades into a real estate career, 3 decades into a private equity career. We just don't live long enough. And so at some point, you've got to find a team or a community of people to trust that. And then beyond that, we've got some guidelines on how we invest. I'm happy to talk through those.
Yeah, no, I think that's great. I'm glad you mentioned what alts are, because that can basically mean almost anything other than the stock market, right? Okay. Yeah. So what are some of your general recommendations, or specific ones, I guess?
One, if I'm starting with a new client, a new member, it is start with what you know. So what industries do you have experience, regions, asset types? Like start with something you understand and then build from there. I never want to put more than 5% of my net worth into any particular investment. I never want to put more than 10% of my net worth with any particular syndicator. Part of what happened in 2015, 2020 is there were a few particular syndicators that did phenomenal, that were doubling their investors' money every 2 to 3 years. And so people just kept their money with them. And then a handful of those really became overextended in 2023, and a lot of their deals went bankrupt or had trouble. And so had they limited themselves to 10%, we're not saying don't invest with people like that. We're saying find multiple people like that. So if somebody's doubling your money, you get to a point where, okay, this is a certain percentage of my wealth. Now I want to invest with somebody else that can also do that. And that's part of where we do that, some of that.
Yeah. Yeah. So they saw significant, really net worth, equity growth, and they just kept rolling their investment plus their return. And when the boulder stopped rolling. Yeah.
Some of those people started with like $500,000, made it all the way up to a $10 million net worth, and then lost it all. Had they instead shifted and said, okay, well, I did that in apartments. Now I'm gonna roll some of that to a private equity fund, or I'm gonna roll some of that to an oil and gas fund. There are multiple people we know in each industry in different asset types that are doing that, and that's part of how we help our members achieve significant returns. Another big element of that is liquidity. Is people were so engrossed in these private deals that it wasn't enough. They were asset rich, cash flow poor. So we want at least 30% of our assets to be liquid, meaning
Mm.
publicly traded stuff or in cash. It could be in Bitcoin, could be in precious metals, just something that you can get access to if you need it. Because there were a couple of people that lost all their money and then had to go get a job, which just sounds terrible
Mm.
after that. And I just feel for them,
Yeah.
which leads
Yeah.
into the next one. We want cash flow that doubles your lifestyle. So if we've got a big buffer of cash flow, you can be work optional.
Yeah. Yeah. And that's one of the things that I really set with me the hardest when I joined your group was the like viewing my financials like a business. And I had a shift years before when I got into real estate. I became self-employed. I hadn't even been viewing my business financials like a business. I had just been running everything out of a checking account, not tracking anything. And I went through like a real estate coach that taught me how to run my real estate business. When I kind of got to where I wanted to be on the real estate side, I was like, hey, I just really want to I want to grow my net worth. I want to grow my investments. And that's when I found you. It just was like a great timing. And that mental switch of, well, you can't just do whatever you want. You can't do what feels good. You can't look at everything that's of interest because there's way too much to look at. So talk a little bit about the viewing your personal finances as a business.
That's a great way to just think about, to the extent that your purpose, your work is to earn money, it's important to realize how all those factors interact. So initially, most people get into a job, maybe start a business, but they have that income. It's not that income that makes them wealthy, though. They've got to take that income and translate that efficiently to assets. It's assets that make you wealthy over time. And you got your income, your wealth, and then thirdly, you've got your lifestyle and giving. And that's like where things kind of come out. And so I almost think of those as three different divisions, with your wealth business at the top. Not to say that your wealth business is the most important thing in your life, but that orientation helps you visualize how you're going to grow that wealth business over time. For example, if you only have $1,000 and you can earn an amazing 20% return, that's $200 in a year. So that's great, but you should probably spend more time growing your career, figuring out how to earn more money, something you control that you can really make a difference in with your time. Then later in life, once you have the assets, if you have $1 million net worth, then a 20% return is $200,000, or a $5 million net worth, that's $1 million a year. And so as your net worth grows, your equity grows in your business, so should the time and effort that you put into your wealth as the business, really recognizing with a little bit of attention, you can likely increase your rate of return and decrease your taxes. And that's really that intentionality, understanding how to help you increase that internal rate of return. A lot of the people that come to us aren't paying attention at all. So our goal is to always increase our members' rate of return by 4%. And you do the math, I'm sure you can extrapolate that out, compounding. It makes a huge difference by the end of your lifetime. And that's money not just for your lifetime, your lifestyle, but also your impact, your family. And there's so much more you can do with that with just a little bit of intentionality.
Yeah. Yeah. One of the very specific things that I learned, through facilitated by your group, but really through Rick, was kind of his numbers to work optional, and drilling down into, I had a handful of rentals and looking at not my ROI, my return on investment, because this was a steal of a deal. I bought off a wholesaler. I put no money into it. I bought it cash, refinanced it, pulled all the cash out. So I was like $5,000 out of pocket, and I had a really nice 2008 4-bed, 2-bath brick home. But what Rick, and you agree with this, but I got it through Rick's little program he taught, was the return on my equity. And what was the return on my equity? And so if I looked at the return on my investment, I was like, it's infinite. It doesn't matter how much money I make. I'm no money out of pocket. But I had a lot of equity in that deal. I had like $100,000 in equity. And I was taking home like $2,000 a year. And that was without any sort of maintenance, that was without any sort of turnover cost, because that tenant stayed long term. And so I realized that like this was not a deal that was actually a good property to hold on to for myself, right? And I should reallocate that money that $100,000 in net worth I had that I was getting 2% return on. I should reallocate that somewhere else where I could get 10, 12, 18 plus, right?
Yeah. There are multiple ways to view this, and that is one metric that's important. And that's one of the things I appreciate about Financial Journey. It's not just about me, it's about a community of folks that offer unique perspectives, and you're going to hear things different ways. And there is no one size fits all. Sometimes just somebody else says something that's a little different that's important. One of the other metrics I really like to look at is return on time. So in theory, your job, you're hopefully not having to put any money into buying your job that you have now. You should be getting paid for it. But clearly there's a cost in the form of your time to get that income. And so that can be, especially with assets you control, what is your return on time to get there? Your return on equity, you've got your internal rate of return, which is my favorite metric to measure all investments across, all passive investments across your portfolio.
Yep. Okay, so I want to transition a little bit. We've talked a lot and we've mentioned Financial Journey. Financial Journey might not be for everybody. I want to talk about what you began doing. Was it 2 years ago? Your more broad passive investor event. So that's coming up later this year. But tell me what got PIE, P-I-E, what got that started?
Yeah, that was really a desire to have a place that anybody can come for a day and really get what they need to take the next steps in their wealth business. So backing up, the reason I started Financial Journey, if I wanted to make as much money as possible, I think going back to commercial real estate syndication, raising money, like that is a fantastic way to make money reliably. My goal is to have an impact on people and help people get clear on like where they want to go, what they want to do with this. And then I can help reverse engineer all the wealth that needs to get there from a wealth, tax, all that perspective. And so that's why Financial Journey, I really get to walk alongside people all year long. And in some cases, there's a few people we do family office management for. For PIE is not everybody needed that level of help with Financial Journey. And so we invented PIE where you can come in, we've got investments, professionals, from your accountants to insurance guys, everybody you need. If you only have limited time and maybe you've got some thousands of dollars to invest, you can come in, hear people. We sell the tickets depending on like $250, $300. We basically sell it at cost. Yep. And it's in the Dallas area. We'll walk you through like a one-page wealth plan. You meet with other investors at a similar place for you, and it's enough for you to get oriented for the next year and then come back.
Yeah, I got to say, one of the best parts of these events for me have always been like the small group setup where, and it's weird, people are not used to, normally people are not used to talking about like their financial goals with a handful of other people. I mean, a lot of times they might not even be super clear what their goal is with their spouse. Like they're going to work hard, they're going to save money, and that's about what gets discussed. And so for me, that's like really refreshing to see people come willing to sit down. It's a highlight for me. You might be in a group of like 4 to 5 people. Keith's group does a great job of like kind of segmenting you so that you're with people, hopefully that you can give some good advice to and you can get good advice from. And you might get 20 minutes where you like outline everything you're doing or going through, what you're planning, and then 20 total minutes. So maybe you spend 5 minutes you explaining, and you get like 15 minutes of someone of 3 or 4 other people really asking you questions, diving into, well, is this actually the issue? Or, well, what's really important? Is it this or is it that? If your kids are really young, maybe your number one top priority isn't working as much as possible, and you just need to make that decision. Maybe that's been an internal struggle. So PIE's been great. You actually get to learn a lot of really cool stuff. So other than having, vendors there essentially that are good, qualified, vetted vendors, what else does an attendee get out of coming to the PIE event?
Well, for me, I love food, so I always try and feed people well. Good lunch. No, beyond that, we walk through. You'll hear state of the market. We'll uniquely set you up with other investors.
Mhm.
Get time with them. Uh, you'll hear there's kind of a choose your own adventure in terms of different speakers. You've got people doing real estate, oil and gas professionals. You really get in a single day can learn from all sorts of people, and then we still have a process for you to do something with that. Often you go to these events and they just try and pack in as many sponsors as possible. We have a strict
It's a
80
pitch
to
fest
20
a lot of
ratio.
times.
Correct. Where we want 80% of the people there investors, and the whole event is focused on investor results, not dollars from sponsors. And that mindset shift means I make less money, but I get members, investors get better results, which is the whole priority of the whole event. And we really want people walking away with something tangible, an action plan that gets them real results. So that's at passiveinvestorevent.com.
Yep. And I'm sure, if you're okay with it, Keith, we'll throw a link in the show notes. I can't imagine you'd have an issue with that, but we'll put that in there, put some info about Pi. And again, there is a difference there. While yes, there are vendors there, there will be syndicators or general sponsors. There will be people with deals there that they would like to raise money for. The deals themselves are not vetted, but the individuals are trusted. They come through, they're people with long-term relationships. They've known each other. They're reliable people. That doesn't mean every deal is going to work out exactly like they said. That is there. I like that there's really a significantly larger educational aspect to it. So, there's basically, from my recollection, there's like a dedicated time where maybe the sponsors get 3 minutes to say what they have, but pretty much everything else from stage is educational. Is that about right, Keith?
Yeah. Yeah. We've got a no pitch rule. And so other than our short period of like 30 minutes where you can just hear the highlights of the deals and you can follow up with individually with whoever you're interested in.
Okay.
We're not trying to be the middleman.
And this is something it's really funny. It's like so weird for most of us in your group who are all in alternatives or significantly in alternatives, because you've really become pretty good friends with some guys who they're in the more traditional equity space, but they do it in a different way. So am I allowed to ask, are Cody or Sven going to be there for Pi?
Absolutely.
Are they doing the family office day?
So what I noticed 2 years ago, almost a lot of our members were really locked up in these long-term private equity deals and were struggling. And as a result, I really made this intentional shift to bringing in more traditional investments. But a bunch of entrepreneurs, they like stuff that they feel like they can control or they've got a unique angle or something.
Yeah.
And for some reason, just putting dollars into the S&P 500 isn't sexy. And so I reached out to some friends who have had some tremendous success investing in different ways. So one of the things that we do is I leave shortly to go on a trip around the world where I'm with my friend Swen, where we're doing events in Hong Kong, London, and New York. And we're specifically trying to identifying emerging hedge fund managers and bring in the best of those speakers to Pi. So 16, 30-minute speakers back to back. That's not how we do things at Pi. It's very interactive, but it's going to be very intense from our perspective. And then I'm going to have a shift there and really help those investment ideas. I'll share some of them privately with our community. But then the real goal is I really want to bring those folks and those ideas to the passive investor event. They're all publicly traded ideas, so anybody can invest in them. If you like what you hear, go out and trade. But you also now have a community and a place to say, is that a good idea? What do you guys think about it? And you can get feedback from other people. And so we're really just trying to bring the best of speakers in traditional assets. We'll have a section for startups, another section for oil and gas and real estate. And so we're really trying to be, we're really more of a connector for the investor across all sorts of industries.
Okay, cool. Now, what I want to ask is who is Pi for? The passive investor event. Because if someone takes the money out of their budget, takes the time out of their week, we want to make sure, you want to make sure that they are getting the most out of this input. So who is this ideally for? Who's going to get the most value out of being here?
Those that are accredited investors and with at least $50,000 to invest, meaning
Okay.
you've got $1 million, including any business equity, real estate equity, all of that. Because a lot of the deals are for accredited investors only. The publicly traded ones could be for anybody, but that's really the folks that are really going to need to focus on wealth as a business and will be able to take action on those concepts.
Okay. Okay, cool. That's good to know. And, but before we wrap up, I do want to ask you if you're comfortable sharing that you have something in the works right now that it might not be currently available when this comes out. But there's something really cool that I think you're doing and you're about to start offering. So what is that?
So discountedrollovers.com. We've previously, as a tax strategist, I've offered a lot of things privately to our community, and this has been something that's been really catchy that hardly anybody doing out there.
Yep.
So this allows you to move money from a traditional to a Roth account at a 30 to 70% discount.
Why would someone want to move from one retirement account to the other, Keith?
Thank you for asking, Jared.
I'm the dummy here. I don't know anything.
You're good. You're good. So traditional pre-tax money, would you rather pay tax on the seed or the harvest? And there can be a debate about when to pay tax and et cetera. And sometimes as you get older, you probably don't want to do a conversion, especially when you're 50 plus. But with this strategy, it almost always makes sense to do it. So the example I'm going to give is, let's say you're investing in a hotel to apartment conversion. Day one, you buy an operating hotel. Day two, you shut it down and you're a passive investor in this deal, going from a self-directed retirement account. What is a shutdown hotel worth? A whole lot less than you paid for it.
Yep.
The risk is higher. We don't have cash flow anymore. And so we revalue the asset. We get an independent appraiser out there to look at it. And then we tack on, for those familiar with estate planning, lack of marketability, lack of control discounts, which in that example will probably get us a 50 to 60% discount. So if it's a 50% discount, that means we're going to roll over the asset, not the cash, from the traditional account to the Roth account. You're going to pay taxes on $50,000, but then it's in a Roth and you're never paying taxes again. Hopefully it pops up in value to $200,000. So kind of just backing up, reframing that rollover, you got $100,000 tax deduction getting the money into your traditional account. You paid $50,000 to roll it over, so you're still ahead by $50,000, and now you've got possibly $200,000 within a Roth, which if you're going to be in it for another 20 years, however long, that could grow over to $1 million that you're never having to pay taxes on again in your life. Like, how much would that just change your life to have that level of money that just feels certain, not worried about taxes? It really is a legacy that either you can spend down or even pass to somebody else, that just gives I think, a sense of security in life. And so we're really rolling out this strategy for and finding deals that we think uniquely fit this, that have a predictable drop in value. And then we manage everything in terms of that whole rollover process to make it easy for the investor.
Yeah. So, all right. So I'm going to recap that for the layman. You have your pre-tax, 401k, IRA, you've gotten your tax deduction on that. If you were to pull that money out cash, you're going to pay the taxes on the money you pull out, and you're paying a penalty, right?
If
you
it's
pull it out
early,
cash.
absolutely. Yeah.
So when you roll it over, when you convert it, let's just say convert. I think that's maybe a more, financial planner language, right?
Sure. Convert,
if you converted it straight to a Roth and you did 100% of that, you might not pay the penalty, but you're paying taxes on everything you convert, right?
Yes.
All right. So that's what we are doing, is we're getting, $100,000 investment. The asset you invested in drops by 50%. So now your $100,000 is worth $50,000 because we're not converting the 100, we're converting the asset. Is that what you said?
Yes.
All right. And so then they have a $50,000 asset and they roll that money over. It's not really related to the difference. It's just what's the asset worth, or their portion of the asset worth. So they'll pay their taxes. They don't pay the penalty because it's still in a retirement account. And then that should rebound based on the normal investment cycle. And then from there, whenever it exits, it goes back into the Roth and it's tax-free on distributions as long as you're after 59 and a half or something.
The plan in that specific example is to reopen as an apartment complex that gets valued differently than a hotel. It's valued based on the net operating income versus a portion of the revenue typically. And it spikes in value, and all that growth happens in your Roth.
Yeah. Okay. Now, let me ask you this. You mentioned that you haven't seen other people doing this or not much. I've actually talked to a number of self-directed IRA custodians that don't really have any idea what this is. And to be fair, they're not allowed to give investment advice. So maybe they just haven't ever gone to the effort to learn about what the power of what people can do. But this is something that is, for all my listeners out there, it's pretty unique. Not a lot of people have talked about this. And I really haven't heard anyone specifically talk about it. So I think it's super cool. I wish I had retirement account money to do this. I do not. I've been self-employed. Yeah, I know. We're working on it. But I've been self-employed for a long time. Small businesses, they never set anything up for me for that. So, you said, what was that? And it may not be live yet. I don't know. Maybe it is, maybe it's not.
Just discountedrollovers.com. You can go out there. The site is mostly there. It's good enough. I know a big part of what we're doing is just educating people about the strategy, because it's not common. At some point, the conversion loophole will get closed, but not during Trump's administration.
Yeah.
And so we've got some time to uniquely take advantage of this. I'm a CPA. My partner on this is a tax attorney, former IRS auditor. So we will represent, talking to the IRS about this. We have no qualms about it. We feel super comfortable with it. We can walk through the technical guide on anybody who has questions about it. This is an awesome opportunity to really move money over while we've got the opportunity, before this tax loophole closes, and we really want to help people make the most of it.
Now, just to be clear, this is not a theoretical thing you've discovered. You've done this and you've walked people through this, correct?
Yes.
Yeah.
I've personally done it.
I just wanted our listeners to know this is something that you have actually done. This is not something that's like novel when it comes to the tax code. Like, you've done it. It's been done.
Correct. We've been doing this privately with our community for years. And part of what I found is, as a tax strategist and having worked with really high net worth people, often the best tax strategies don't get openly discussed. Because if they do, they get more traction, they get more awareness,
attention,
and then the IRS closes them. And so, yes, I'm sharing it on this podcast now, thinking, okay, the Biden administration is done. We're ready to step into this, because we don't have somebody we think is going to close the strategy and really say, we've got 4 years to make the most of this, and then we'll see what happens.
Okay, very cool, very cool. All right, so we've talked about PI, we've talked about discounted rollovers. We're going to have links for both in the show notes if you're cool with that. That way people can find more info. They can take a look at it. And hopefully I'll be at PI this year. Obviously you'll be at PI this year. So I'd love to meet anybody who's heard this. But Keith, this has been great. I've really appreciated this. Any final thoughts that you have on what someone who, let's actually take it, let's make it even more foundational. Someone who is not an experienced passive investor, what would you recommend their first or next steps be if they think there's a smarter way for them to start investing their money or start working towards? They might have always said retirement. Me and you like that work optional phrasing.
Yeah. So there's an element. Some is just opening your mind to what's possible. Our punchline is we help people reach work optional in 3 to 5 years. So often a lot of people that come to us already have the assets and they don't know how to make them cash flow. So usually within a short period of time, we can show them how to optimize those assets. They're still fully in control of all the assets. We like to show people how to do it themselves and get comfortable over time. If you're not sure about this stuff, just get around other people that are on this journey. I would love to be somebody you speak to. Come to one of our events, speak to your. I'm happy to speak to you personally. Come meet our community, and we've got a genuine generous group of people that really like helping each other, and people, it feels so weird until they experience it and they realize it's real. And I just really want to encourage people to be intentional. I know how easy it is as a father of two boys, ages 3 and 6. It is easy to get caught up in just doing life, and forget this, but often people miss that power of, if you do stuff now when it's early and you allow compounding to really
Mhm.
make a difference, small steps now make a big difference later. If you're trying to catch up 5 to 10 years before you retire, you're going to be hurting. But you can do little things now that will make a giant difference in your future later. And you may even be able to be work optional, meaning you don't have to work anymore. The thought of not working terrifies so many people, but often people can find other ways to fill that time. And it's like, what do you truly want to be doing? And most people don't know. And sometimes just being around other people that have that mindset, that are work optional, can
Mm.
open your eyes to the possibilities. And once you know, now you can start to impact your family, your friends, those around them. And I really just don't want people to feel stuck in something that they hate or they don't like, because there's a whole future out there that could be for them,
Yep.
and a whole eternity. And that's really what we want to set people up for, is to impact people for this life and the next.
Okay, Keith, thanks for being here. And if this is this is the first episode, but if this is also the first time you listeners are listening and checking this out, hit that subscribe button. Come back for more. We're excited to do this, and hopefully we can continue to provide just really helpful, relevant content. So, Keith, thanks for being here.
Thank you. And I am definitely going to subscribe.
All right.
Okay, now I want to give one more huge thanks to Keith for being here today. And if you are newer to investing, or you know that you could be making improvements and in managing your money a little bit better, go check out the Passive Investor event in the description below. That is going to be a place where you can meet like-minded investors and hear from industry experts about what's going on in the market and where the best opportunities are. Now, if you can't wait till October and you have deals that you need to review now and would like some help, go check out the description for my free guide, How to Use Chat GPT for Due Diligence, below. And I'm looking forward to seeing you next time.